Ever wonder why your paycheck isn't going up, but the price of everything else seems to be skyrocketing? Turns out, some of the biggest mega companies are spending billions on stock buybacks instead of investing in their workers or lowering prices for you. Hi, I'm Holbrook. Here's what's on my mind. Corporate stock buybacks are one of the root causes of the affordability crisis. Let's break down how this corporate shell game is leaving everyday people, like you and me, holding the bag, while executives and shareholders laugh all the way to the bank. So, what the heck is a stock buyback? Stock buybacks, also known as share repurchases, are a common corporate practice where a company buys back its own shares from the marketplace. And in this video, I'm talking about the mega transnational corporations. This financial maneuver can influence the company's stock price and its earnings per share, among other financial metrics. The debate over the economic and ethical implications of stock buybacks is intricate, touching upon issues of corporate governance, shareholder value, income inequality, and economic efficiency. In this video, we'll explore the historical context, current practices, problems, and impacts of stock buybacks. Let's look at the historical context and early regulation. Initially, stock buybacks were viewed suspiciously and were often associated with market manipulation. During the early 20th century, U.S. regulators imposed strict limitations on the ability of a company to repurchase its own stock. The concern was that buybacks could be used to artificially inflate stock prices, misleading investors, and creating unstable financial markets. This perception changed dramatically in 1982 with the Securities and Exchange Commission's (SEC) adoption of Rule 10b-18, which provided companies with a safe harbor to repurchase their stock without fear of being accused of market manipulation, as long as they adhered to specific conditions regarding the timing, price, and volume of the repurchases. This regulatory change came during a broader wave of deregulation in the financial industry, influenced by a growing belief in market efficiency and the benefits of shareholder value maximization. The rise of stock buybacks. Following deregulation in 1982, stock buybacks surged. Companies, now with more leeway to manipulate their stock prices without legal repercussions, increasingly turned to buybacks as a strategy to return surplus cash to shareholders, improve financial metrics, and often boost executive compensation, which was increasingly tied to stock performance. Surplus cash sounds so cute, but at the quantities we are talking about for mega corporations, this realistically equates to monopolistic pricing. Several factors led to the prevalence of buybacks in recent decades. First, excess cash. Companies with surplus cash find buybacks a quick method to return value to shareholders. Second, tax advantages. Buybacks are often seen as a tax-efficient method to return money to shareholders compared to dividends, which are taxed at the individual level. Third, earnings management. Buybacks can increase earnings per share, making the company appear more profitable and efficient than it might actually be. Critics argue that buybacks can distort the true value of a company. By reducing the number of shares outstanding, buybacks increase earnings per share and can make a company's financial performance appear better than it actually is, potentially misleading investors. Investing in buybacks often comes at the expense of other potential uses of cash, such as capital expenditures, research and development, or employee compensation. This can lead to underinvestment in the company's long-term growth or in its workforce, potentially harming the company's competitive position and the economy more broadly. Buybacks can exacerbate income inequality. They predominantly benefit shareholders, who are typically wealthier individuals, and top executives, whose compensation is often tied to stock performance. This can widen the wealth gap between the top echelons of corporate leadership and average workers. That's you and me. While stock buybacks can boost stock prices in the short term, they might pose long-term challenges. By focusing on short-term price enhancement, companies may neglect necessary investments in innovation or workforce development, potentially undermining their long-term sustainability. Influence on economic cycles. Buybacks can also influence economic cycles. During economic downturns, companies may cut back on buybacks, which can exacerbate market declines. Conversely, during economic upswings, buybacks can contribute to stock market bubbles. In summary, stock buybacks are a powerful tool for companies to manage their financial resources and shareholder relationships. However, their impact on the market, the economy, and society is complex and multifaceted. As debates continue and new data becomes available, it is crucial for policymakers, investors, and corporate leaders to carefully consider both the benefits and the potential drawbacks of stock buybacks. The challenge lies in balancing these factors to foster long-term economic growth and stability while ensuring fair and transparent market practices. The dark side of stock buybacks. Profits for shareholders, costs for society. In recent years, stock buybacks have become a hallmark of corporate strategy, a seemingly simple maneuver that inflates stock prices and rewards shareholders. At first glance, the concept is alluring. Companies repurchase their own shares, reducing the number of outstanding shares in the market, which often leads to a rise in stock prices. This in turn enriches shareholders, particularly executives, whose compensation packages are tied to stock performance. But beneath this veneer of financial success lies a troubling reality, a practice that, while beneficial to a select few, comes at a significant cost to workers, consumers, and the long-term health of the economy. Short-term boost. Stock buybacks are often praised for their ability to deliver quick returns to investors. When a company buys back its own shares, it reduces the supply of shares in the market. With fewer shares available, the price per share tends to increase, providing an immediate, though often short-lived, boost to the stock's value. For shareholders, this can translate into substantial gains. For corporate executives, whose compensation is frequently tied to stock performance, the incentive to engage in buybacks is clear. However, the emphasis on buybacks reflects a broader shift in corporate priorities, from long-term growth and investment in innovation to short-term gains and shareholder appeasement. This shift has profound implications not only for the companies involved, but also for the broader economy. The opportunity cost of buybacks. The funds allocated to stock buybacks represent a significant opportunity cost. Every dollar spent on repurchasing shares is a dollar that could have been used for other, potentially more productive purposes. For instance, companies could reinvest in their workforce by increasing wages, enhancing benefits, or providing better training and development opportunities. Such investments would not only improve the lives of workers, but could also lead to higher productivity and, in turn, more sustainable long-term growth for the company. Moreover, companies could allocate these funds to research and development, which is critical for innovation and maintaining a competitive edge. Instead, many firms prioritize short-term stock price gains over investments that could drive future growth. This myopic focus can leave companies ill-prepared to navigate future challenges, ultimately harming their long-term prospects. The consumer burden. Another often overlooked aspect of stock buybacks is their impact on consumers. The funds used for buybacks don't materialize out of thin air. They come from the company's profits that are, in part, derived from the prices consumers pay for products and services. In other words, consumers may unwittingly contribute to the very buybacks that serve to enrich shareholders at their expense. If companies redirected funds from buybacks to lowering product prices, consumers could benefit directly through more affordable goods and services. This could, in turn, stimulate demand and drive economic growth. But when the focus remains on buybacks, the benefits accrue disproportionately to shareholders, while consumers see little, if any, positive impact. Stock buybacks exacerbate income inequality by funneling profits to shareholders and executives, who are typically among the wealthiest individuals. Buybacks contribute to the growing divide between the rich and the rest of society. Meanwhile, workers' wages stagnate, and consumers bear the burden of inflated prices. Furthermore, The emphasis on buybacks undermines the long-term stability of the economy. Companies that prioritize short-term gains over long-term investments risk becoming less competitive over time. As innovation slows and productivity growth stalls, the broader economy suffers. The time has come for a serious reevaluation of corporate priorities and a reassessment of how companies should allocate their profits. Stock buybacks, while providing immediate benefits to a select few, represent a misallocation of resources that can be far better spent on initiatives that drive long-term growth and benefit a broader segment of society. Instead of prioritizing the short-term gratification of rising stock prices, companies should focus on creating sustainable value for all stakeholders: workers, consumers, and the economy as a whole. To achieve this shift, federal intervention may be necessary. The government can play a crucial role in curtailing the excesses of stock buybacks through targeted laws, regulations, and policies. One potential approach is to introduce legislation that requires companies to balance their financial strategies. For example, if a company chooses to allocate funds to buybacks, it can be required to invest an equal or greater amount in increasing worker wages, improving benefits, or enhancing workforce training and development. This would ensure that employees, who are often the backbone of a company's success, share in the financial rewards currently reserved primarily for shareholders and executives. Another regulatory approach could involve placing a cap on the percentage of profits that can be used for stock buybacks. By limiting the amount of money that can be funneled into buybacks, companies would be encouraged to allocate more resources toward R&D, infrastructure, and other long-term investments that are critical for sustained growth and innovation. This would help ensure that companies remain competitive in the long run, rather than succumbing to the temptation of short-term financial engineering. Additionally, policymakers could consider tax reforms that disincentivize stock buybacks. For instance, imposing higher taxes on buybacks or creating tax benefits for companies that prioritize investment in their workforce and business operations could shift the focus from immediate shareholder returns to long-term economic growth. These tax policies could be designed to encourage companies to reinvest in their employees, reduce prices for consumers, or invest in innovation, each of which would contribute to a healthier, more equitable economy. Another potential reform could involve stricter disclosure requirements. Companies could be mandated to provide detailed reports on their buyback activities, including the rationale behind the buybacks, the anticipated impact on stock prices, and how these actions align with the company's long-term strategic goals. Enhanced transparency would not only inform shareholders and the public, but also hold companies accountable for their financial decisions. Finally, the government could consider enacting policies that tie executive compensation more closely to long-term performance, rather than short-term stock price movements. By restructuring compensation packages, companies could be incentivized to prioritize sustainable growth and innovation over quick financial fixes. This would help align the interests of executives with those of the broader economy and society. Stock buybacks are often seen as a clear manifestation of corporate and executive greed, prioritizing short-term financial gains over long-term investments in the company, its employees, and its products. At their core, buybacks allow companies to artificially inflate stock prices, which directly benefits shareholders and, most notably, corporate executives, whose compensation packages are frequently tied to stock performance. This focus on enriching the few at the top can come at the expense of broader economic health and equity. Take, for instance, the case of Boeing. In the years leading up to the 737 MAX crisis, Boeing spent over $43 billion on stock buybacks between 2013 and 2019. These buybacks were heavily criticized as they appeared to prioritize boosting short-term stock prices over investing in product safety and development. After all, why bother making sure the planes actually stay in the air when you can just watch your stock price soar instead? The company's executives, who saw substantial increases in their compensation tied to the rising stock price, were accused of neglecting critical engineering and safety concerns. When the 737 MAX was grounded after 2 fatal crashes, the company faced intense scrutiny, and the true cost of prioritizing share buybacks over safety became tragically clear. Another example is General Electric, which engaged in aggressive buybacks throughout the 2000s, spending billions to prop up its stock price. In 2015 alone, GE authorized a $50 billion buyback program. Who needs to worry about long-term financial stability when you can just funnel cash into buybacks and call it a day? However, this focus on financial engineering over investing in its core businesses contributed to GE's significant decline in subsequent years. The company faced financial difficulties, massive layoffs, and a collapsing stock price, leaving many workers and long-term investors in dire straits. Meanwhile, GE's executives had reaped considerable rewards during the buyback-fueled stock surge, raising questions about the ethics of such strategies. Even tech giants like Apple have not escaped criticism. While Apple's buybacks, amounting to over $500 billion in the last decade, have significantly increased shareholder value, they have also raised concerns about whether this capital could have been better spent on innovation, expanding employee benefits, or addressing broader social responsibilities. Sure, Apple could spend a little less on inflating stock prices and a little more on, say, reducing that $30 charging cable or paying the store employees more, or start manufacturing in the US. But where's the fun in that when you can watch your stock price climb? Critics argue that, despite Apple's massive profitability, the focus on buybacks over more meaningful investments highlights a broader trend of corporate leaders prioritizing personal and shareholder wealth accumulation over sustainable and inclusive growth. These examples illustrate how stock buybacks can serve as a tool for corporate and executive greed, driving up stock prices to maximize personal financial gain at the expense of long-term company health, worker welfare, and product quality. The allure of short-term profits often overshadows the need for responsible corporate governance, with dire consequences for both the companies involved and the broader economy. This has been a long one. Let's wrap up here. While stock buybacks may offer a quick financial boost, they often do so at the expense of workers, consumers, and the long-term health of the economy. The federal government has a critical role to play in reshaping corporate behavior through thoughtful legislation and regulation. By encouraging companies to invest in their workforce, reduce prices for consumers, and focus on sustainable growth, we can create a more equitable economy that benefits all stakeholders, not just a privileged few. Don't forget to hit like and subscribe, and share your thoughts below. Let me know what you think.